And right, thank you for that, Amy. Thank you for joining us today. It's my pleasure to introduce to you Kevin Phelan, Senior Vice President of Marketing at OpenLending. Kevin is going to share some valuable insights today that will allow your credit union to make more informed lending decisions, manage risk, and remain competitive in today's auto lending market. Um, so, and that's it. Kevin, the floor is yours.
Great. Thanks, Dean. I appreciate the Cooperative Credit Union Association for having us on. We've been doing quite a bit of research over at OpenLending into auto lending, and specifically is this presentation is going to go into a little bit more depth on the near and non-prime consumer in the automotive marketplace and what's happening. So what I thought maybe I'd start with is just a little bit of context on what we see happening right now. And this is from our latest research report that we do have available. It's a free report for download. There'll be at the end of the presentation, I've got a QR code. And if you want to, use your camera to capture the QR code, it'll take you directly, navigate you right to the page where you can download the full report. I'm going to give you highlights from this report at this moment. So with that, just, right now, the economy has these indicators that would tell you that we're in a pretty good spot. Inflation's moderating, the unemployment remains relatively low. Participation rate's a different story. US GDP continues to be up, but as inflation continues to be up as well, we're all kind of waiting to see what will happen with the Fed and rates. And I don't want to ruin the party here, but there's a significant affordability gap that is taking place, and it's only widened with each successive quarter since the Fed began raising rates back in March of 2022. And the credit tier right now that is taking the brunt of this widening gap is not subprime, it's not deep subprime, it's really truly today's near prime and non-prime consumer. The one thing that we track this monthly and quarterly, but when we look at super prime, they're actually buying and registering more vehicles than they were since the Fed started raising rates. Prime is holding its own. The piece where if you look at the rates on used and new and the growth of rates and the growth of monthly payments and they're all up highest in the near prime non-prime segment, and the penetration of near prime non-prime has gone down dramatically with each rate increase. And so why does any of this really matter? If near and non-prime consumers are caught unable to finance, why should I be worried about that? The OEMs are back to making money. Dealers, I think we all recall fairly well the full shutdown that took place at the height of COVID, but they went from being in a full shutdown at the height of COVID, which I think yesterday marked 4 years, the day that things really started going into shutdown. If you remember the Oklahoma City Thunder Utah Jazz game where they shut the game down in the arena and sent everybody home. And that's when I think everybody started to say, wait a minute, something really different's about to happen. But the economy's rebounded from that, and dealers went to having record profitability years. And as a bank or a credit unions in this space, many of the institutions that we work with, they say, listen, we don't have a lot of liquidity now, and perhaps we should just sit a few rounds out. We'll pull back from indirect automotive lending. We'll pull back from automotive. And maybe at a minimum, you might be saying, let's just pull back from anything below prime for the time being. What I hope to offer is a little bit of more context and consideration for what might happen. It struck me last week when I was at GAC that when they put up on the screen that the mission and vision of America's credit unions that now coming together of CUNA and NAVQ was that people everywhere trust and partner with credit unions to help them afford and achieve their best lives. But what's truly happening is that the credit score, the average credit score, and I'll show you some data on this in a minute, for used car and used car loans, particularly out of credit unions, it's amongst the highest when you compare credit unions to banks and the captive lenders. If the credit union member today that's near prime and non-prime is unable to access auto financing, the thing that's going to happen is that consumer will be forced into unreliable or unaffordable cars. And they'll either be in a car that today, the average age of a car today is gaining every time we check. This is at 12 and a half years old is the average age of the car on the road in the US car park today. And reliability starts to become an issue, particularly for the near prime, non-prime consumer. And the longer they have to remain in that car, the more likely it is that they'll be forced to make even more costly repairs because they're not able to afford purchasing a new or new to them vehicle. And then once we do that, the latter metaphor comes into play because we know from data from the CFPB that the near and non-prime consumer is the most likely credit tier to move up within 12 months. They run a consumer panel pre-COVID over a 9-year period. 34% of near prime consumers moved up to prime or better within 12 months of them being evaluated. During COVID, the COVID era, it was 43%. A lot of stimulus was pumped into the marketplace, as we all know, but 43% of near prime members, near prime consumers moved up to prime or better within 12 months. They've yet to release the post-COVID analysis, but expect it to be somewhere between where we were in the 9 years prior to COVID or the 3 years in the COVID era, the COVID period of stimulus. Without an auto loan being offered to them, though, they are going to find it much harder to climb that credit ladder. That rung on the ladder is being pulled away from it, and we are seeing evidence of that in the marketplace today. If we look at the average credit score on a used vehicle and broken down between credit unions, captives, and banks, on the left-hand side, what would you think would be in the wheelhouse of a credit union? Credit unions now have the highest average credit score financed on a used vehicle at 720. It's above what the average credit score is on used vehicles for a bank or a credit union. You see it on the left-hand side. On the right-hand side, you see something very similar where credit unions were kind of leading the way as rates started to increase and as liquidity started to kind of come into question. It's not that the near prime, non-prime consumer doesn't want to buy a vehicle. And I'll show you some of this research that we have from the 2024 Vehicle Accessibility Report. But there's something definitely happening in the credit union space. And so one, want to call attention to that, and two, talk about the implications of that and really want to ground that based on what we're seeing in this Vehicle Accessibility Report that we just recently published. So a little bit on OpenLending, on who we are and why we're so fascinated with this portion of the consumer base. We are an automotive lending solution provider to financial institutions. We've been in business 23 years now. We focus on the near and non-prime segment in automotive lending. And we were the first to recognize this $270 billion opportunity in lending in the near prime space. And so why near prime? We routinely hear in engaging with both credit unions and banks that the near prime consumer is the hardest for them to make a solid decision on how to evaluate that application when it comes in. And frequently what we see is one of two things if you're not using better data and being able to move quickly. One is you'll end up scoring it more like a subprime score and denying them access to credit. And that may well fit with the risk tolerance for your credit union, as we say here today. Or they are approved, and which ones of those are the ones that are likely to default? Well, that's where OpenLending comes in. We model out the probability of prepay, the probability of default, the severity of the default, which is very different from the Synaptics and the Zests that are out there talking about fairness and lending. The real question is which of those applicants is likely to have an issue and default. And then the most important compelling piece we do at OpenLending is providing default insurance in the event that that loan were to go bad. So a little bit more on OpenLending at a later date, and we've got the ability to put you in touch with someone if you want to know more about that. Now let's get into the actual research itself. So just for setting again more context on what this research is and who it's focused on. We ran this in Q4 of 2023. We surveyed over 1,000 consumers who fall within two credit brackets: near prime, defined as a credit score of 620. to 659. And then non-prime is a credit score between 580 and 519. So I think 580 up to about 660. Those are the consumers, and we wanted to find out more about what it is that they were looking to do in the automotive lending space, and how they were feeling about buying a vehicle, financing that vehicle, and the institutions that provide that financing. So, ironically enough, as much as all consumers have been challenged, and this consumer has been challenged with inflation, this group is actually feeling pretty optimistic about their overall financial situation. 74% responded that they feel their situation is likely to improve in the year ahead. They've managed their debt successfully. They have intentions on making large purchases this year, and they feel confident in their ability to handle that responsibility with ease. When we ask them a question around, well, which of your bills are you likely to deprioritize should your financial situation, take a turn for the worse, the auto loan is right there with rent and mortgage. 9% said that they would likely deprioritize an auto loan, which is the same rate that they would likely deprioritize a rent or a mortgage payment. But 34% said credit cards, 29% was on their phone bills, 15% on utilities. So you kind of have this proxy for their hierarchy of needs based on their response to this question. They absolutely prioritize that auto loan. It's in their minds, it is definitely tied to their ability to have their livelihood. They are, by all accounts, a dependable borrower. And so 69% said that they are looking to pay off their car loan early. This is a really important stat, and I want to come back to that in a moment. 77% have not been late on any car payment within the last 3 years. And so the question is, why are they non-prime or near prime if that's the case? Why would that be? And I think the more important question is, why are they not prime yet? I mentioned the CFPB data. What we tend to see in the near prime tier are consumers that are on the rise. This is a consumer who's think of thin file. They way over index in millennial and Gen Z. They don't have as much experience with lines of credit, and therefore when they do apply for a loan, that credit score is a bit lower than their older cohorts that are in the marketplace. What they are seeing when they go into the marketplace, that's a little bit different. 21% of them would like to purchase a vehicle within the next 12 months. 11% said that they would like to purchase a vehicle as soon as possible. There is a general lack of used vehicles in the wholesale marketplace for dealers. And so I talk about that 69% stat in terms of looking to buy a vehicle within the next 2 years. The one thing, and those of you that work with automotive retailers that you'll know as a fact, is that they tend to market heavily to those consumers who are in an equity position in their existing car loan. And when they find someone who's paid off that car loan, they really go hard to try and get that consumer to come in. And when they're in an environment that they're in right now today, and that is that they don't have used vehicles, ample supply of used vehicles like they did pre-COVID, pre-supply chain shortage in the wholesale marketplace, the most profitable unit that a dealer can put on their lots is one that they take in on trade. So I would expect that even though this is the stated intention of 21 and 11%, the activity that we're likely to see there may well be in advance of that. And that portends a lot of things will stay the same as that we have them today and not get worse. If it gets better, I think that number has even more upward pressure in terms of the number of consumers who are going to be in market for a vehicle based on having a good deal put in front of them, based on an aging vehicle that's in their driveway or in their garage today. So some things to think about though, and what it is that they've been seeing over these last couple of years and what came up in this survey. The percent of near and non-prime consumers who are paying over $600 a month in 2020 and 2022, 44% of consumers in the near prime, non-prime segment were paying over $600. That number has almost doubled. It's now at 79% in 2023. So we've run this survey a number of times, and what we are now seeing in terms of the number of consumers and what they're taking on as a monthly payment. A study that came out last year by Edmunds detailed how 17% of auto loans, get ready for this, they now have a monthly payment of $1,000 a month or more. And that's something that was absolutely unheard of 3 years ago. I mentioned this earlier, the near prime tier, they've seen the greatest increase in rate and monthly payment of any credit tier since the rate started to increase from the Fed 2 years ago. So what are they doing? Well, one of the things that we're seeing is really thinking about leasing in ways that they weren't before. So for that response, 61% that have gone to leasing either do that because of the desire to avoid any kind of monthly expense, or quite simply their inability to qualify for a monthly loan that wasn't going to break their household budget in terms of monthly payment, or in terms of that sense of I'm being taken advantage of, I'm paying too high a rate. And when I go in and apply at my local credit union, I feel like I'm being penalized. And this theme started to come up again and again as we went through the survey itself. When they said why they're starting to turn away and turn their backs a little bit on the bank and credit union borrowing experience, a third of the respondents bought their cars outright. And they did so, 38% said they did so to avoid debt. 1 in 5, 21%, said they wanted to forego those monthly payments and the fees that were associated with them. There is a strong preference for used here. 75% of the near non-prime consumers we talked to, when they purchased their vehicle outright, they went used. And so you're probably seeing some of that in the applications that you're taking in right now. So there is this really large divergence, and what came through loud and clear in the survey is that there is this divergence between their expectations and the reality. 28% said their monthly payments were far higher than they expected. The interest rates were higher, and the loan terms themselves were longer in order for what the institution, what the credit union was willing to offer them. And you see these stats, and what starts to emerge is this sense of I'm not being treated fairly. And think about the younger consumer, that thin file that I mentioned, who's fairly new to credit. Here's a consumer whose confidence in their prospects, as we stated earlier, was very high. They've done well in managing their debt so far, and yet they come in and apply for the loan, and they're hit with monthly payments, interest rates that are, and loan terms that are different from what they thought they would be able to qualify for. And they're being made to feel as if they've done something wrong. The most confusing and unclear part of the whole process, again, comes back to rate and monthly payment. If we kind of go a little bit further, this shows up in a matter of trust itself. And so fairly complicated chart in terms of little and no trust up to high degree of trust when it comes to a traditional lender, a bank, or a credit union, to the auto dealerships in the middle, or the automotive alternative lenders on the far right-hand side. So let me break it down this way a little bit. So if you think about the traditional lender, the credit union, only 13% said that they had no trust to little trust in the bank or the credit union. Now compare that to automotive dealerships and alternative lenders, where that no trust, little trust, it gets amplified by a factor of 3. I would just flip that around. 87% said that they had either moderate to a great deal of trust in their local lending institution. However, once they get into the automotive loan process, 48% says that causes them, because of the monthly payment, because of the rate that they're being given, or the longer term that they would be forced into, 48% said that that causes them to lose trust with this institution. So 87% having high degree of trust, or a moderate amount of trust, all of a sudden that gets stripped away pretty quickly when they're quoted at a rate that they don't feel jives with how they have been performing. Some color commentary here. One of the exact quotes from one of the survey respondents: I feel like the financial institutions make it somewhat more challenging because I've noticed that they're a little biased towards people and can be judgy about what they can afford. Think about the fact that millennials and Gen Zs, for the majority of their, and then for some, for their entire lives as an adult consumer, where they're interacting with lines of credit, money has been effectively free. And this is the first time over this last 2-year period where the Fed rate increased to a level where now they're getting hit with monthly payments and interest rates that are at a rate that they're not accustomed to. If you're in an older cohort, myself, folks that are older, you're not immune to the fact that, hey, you might have to pay an 8% rate on a 30-year mortgage, or you might be expected to see something between a 6 and a 10% car loan rate. And those are rates that this consumer has never seen before. They didn't know such a thing existed. So we went and looked at the Gen Z car owner in this survey in even more detail. And again, want to state this, that this is a consumer that's not because of mistakes necessarily that they've made, but because they've been far later in hitting many of the milestones that older cohorts, consumer cohorts hit. So if you think about Gen X, boomers, they got their first jobs earlier. They had their access to their first line of credit much earlier. They bought their first home earlier, got married earlier, had children earlier. Not so when you look at Gen Z and millennials. And because they were much later in establishing lines of credit, in terms of job, establishing a line of credit when they graduated even from college, they show up very differently in terms of credit score. They far over index what you might see in terms of a credit score in the near prime space. When we talk to them even further, though, 82% of the Gen Z that were in near prime, non-prime, 82% were paying an APR of 6% or more on their auto loan. When we looked at all near and non-prime, it was only 73% were paying at that rate. 80% of Gen Zers are spending over $400 a month on their car payment, compared to only 39%, or half of those are in the age cohort in the ages of 43 to 68. Their likelihood in this case, we broke it down by age group. The Gen Z and millennials far more likely to purchase a vehicle in the next 2 years. 63% of Gen Z said they would, 72% of millennials said they would, compared to 55% that are in an age group of 42 or older. And so that kind of brings us to a little bit of some summation points here. These consumers, they are ready to purchase. And I would ask you to just examine it and say, are we as lenders, are you as a lender, are you ready to meet them with terms and conditions that they're expecting to see when they come into the auto lending process? And if you aren't, who will? I would tell you that when we looked at this report a year ago and did a similar survey a year ago, 83% of consumers who had a positive auto lending experience said that they would return to the same financial institution for their deposits and for their other banking and lending needs. And so failing to take in the data to understand this consumer, they may have a fairly low credit score. When you look at the traditional credit scoring methodologies, you're going to need to look at a broader set of data to have a better idea of who is creditworthy in that near and non-prime space, so that you can have an opportunity to connect with them on a loan that has a monthly payment, a rate, and a term that meets up with those expectations. So as I mentioned, I do have an ability for you to get in touch with me here. Here's my email address if you have questions on this report. We just recently also published a report on I-10 lenders, so those that have an individual tax ID number. It was a joint piece of research that we did with Filene and the Filene Institute. And we've got another piece of research coming out that's just squarely focused on Gen Z and millennials, joint research with TransUnion that should publish later next week. And so if you have questions on this or any of the other research reports that we have published on our website, by all means, reach out to me. To read the full report, you scan this QR code with your phone. That'll take you to a page and you can download the full report itself. As you read that, if you have questions, by all means, feel free to reach out. Happy to take questions via email or questions now if time allows.
If anyone has any questions, please feel free to unmute yourself, or if you're not comfortable doing that, you can certainly put them in the chat and we can read them off to Kevin for you. Well, I give people a chance to think about their questions. So quick question that maybe you can answer. How easily does OpenLending integrate with credit unions' LOS systems?
So we actually have via APIs for most of the LOS systems that lenders are using. It really is more of an activation, less of an implementation. So Meridian Link, Origins, a lot of the credit unions that are on those LOSs, and we're finding that the work that needs to happen in order to get an implementation done or an activation done really comes down to just having your accounting team with the right codes set up for these loans. So and happy to connect anybody. You know, we're partnered up with credit unions of all sizes. So from some of the smaller asset size, smaller resource teams to some of the largest across the country. And so if you have a desire to speak to a chief lending officer or a VP of lending at any of our clients that have recently been through activation with us, happy to connect you with them. So it's not a matter of, you know, us telling you, hey, it's going to happen in such and such amount of time. You can hear from them on terms of how they were readying themselves for bringing on OpenLending and the service that we provide.
In the credit unions that are currently using open lending, are you finding that they're able to lend a lot deeper into some of that D and E paper that they normally wouldn't have considered in the past without having this tool?
Yeah, and that's kind of the two things kind of happen. One, Dean, is that the being able to look at the 2 million risk profiles that we've got on, you know, how does this consumer behave in terms of how they work with their cell phone bill? How often are they changing jobs? That comes into play with being able to take a score that might come in as a 620. And then when it's rescored, that score comes up based on stability and profiles that we see. The other thing that kind of comes into play is what is the vehicle that they're buying and how that collateral is really important in terms of determining severity of loss. And so a better vehicle, a vehicle that's going to perform better over the life of that loan in terms of the potential loss that it might represent, that's a really important component that's missing from, you know, anyone else that might be looking at this in the industry. And so being able to um, assess both the applicant and the application on the deal, like what is the actual vehicle that's being purchased here, that actually changes the interest rate and can get a better rate, a better score to a better rate to a better monthly payment. And that's why they're having better success in being able to buy deeper. The second real big component of this thing is the insurance and the default insurance, so that uh, you know, we all see the rise in delinquencies and defaults that are happening on the automotive side. We're also very well aware of what regulators are expecting of institutions and what they should be provisioning for expected losses under CECL rules. And we have a number of clients that are telling us that, hey, they're able to greatly reduce their CECL reserves based on the fact that they now have default insurance to offset those losses.
All right. Well, thank you for that information. Anyone else have any questions? We still have a few minutes open. And Kevin is able and willing to answer questions, so please feel free.
And one other component of the program I think that's important too is that ability to pull the credit score one time. So think about if you have an indirect lending program and you know, the process of the consumer at the dealership, you know, they went in potentially even pre-approved up to a certain level. And with inventory being what it is and being a little bit low on the lower side, prices being still higher, they're starting to attenuate a little bit, but they're still higher than expected. That ability to provide, you know, greater depth and greater flexibility, not just on the credit score, but also on the loan to value amount. We're helping expand what the buy box would be for many of the credit unions we work with, not just in terms of loan score, but also in LTV, without having undue risk on the books because of the default insurance that we offer.
Well, it looks like we have a shy group this morning, so no one seems to have any questions. If anyone does think of any questions and you did not capture Kevin's email, please feel free to reach out directly to me, and I will be happy to pass those along to Kevin and ask them to reach out directly to you. Kevin, thank you very much for your time this morning. I appreciate all the valuable information that you shared, and I hope everyone enjoys the rest of the day. Thank you.
Thanks, Dean.